Hey guys, and welcome to another session where we talk about different things that occur in the stock market. We look at different trading strategies and we talk all things stock related. So, in today's session, what I actually want to talk about is knowing the difference between good investments and bad investments, and this is in particularly related to the stock market. So a lot of times there are deals out there that seems too good to be true, and sometimes they are too good to be true, and other times there are also gems that you find. And so when you find these gems, you really want to just act upon it and you want to move as quickly as possible. And so I want to share with you just a few tips and tricks that I use to actually identify good investments from the bad ones. So the first thing that you want to do when you are actually investing for the first time in a new sector, in a new company, in a new industry, what you want to do is you want to look at the fundamentals. And there is a saying that goes, the proof is in the pudding. So numbers don't lie. So the first thing you want to do is calculate the ratios. And my biggest and best suggestion is find the best company in that sector, in that industry, and then you calculate the ratios on that company, on that industry. You look at the revenues, you look at the market cap, and then you find another company, the one that you would be interested in, and then you do the exact same thing, and then you compare the ratios. So a few of the ratios that I like to look into is the liquidity ratio, the profitability ratio, the returns, and the debt ratio. So those are the four main types of ratios that I personally tend to look into when I am investing. And I really believe that the reason why I like these ratios is that the liquidity tells you how well the company manages their cash. And so what that means really is just, is the company, if something should occur in the short run period, will the company be able to cover these expenses, or would they actually start to struggle and really suffer a little bit and run the risk of being illiquid or even insolvent? And so that's really why I love the liquidity ratios. The reason why I love the profitability ratios is because who doesn't like profit? And the more profitable a company is, the better they look at. And so my experience over the years is that on average the returns on assets are usually between 5 to 8%. But if you find a company that's ROA is actually 10% or above, even 15%, 20%, then that usually means they are doing something very well. And usually they are very new to the market, so they would probably have just had an IPO maybe a few months ago. And so this is the reason why the ROAs look so high, because the investors have not yet been drawn to the company. And so the equities would still be fairly stable, still be fairly relatively priced, and so the returns that the assets would be giving compared to the equity would be pretty fair and in good condition and good standing. And the return on equities now will just really tells you how much money you will be getting back based on how you invest in the company. And so return on equities, you usually tend to look for ROEs between 15 to 20%. But if you find a company that's paying a much higher ROE, then that also would be a great thing to look at. And the last thing is the leverage ratios. Now, the amount of debt that a company takes on can either make them or break them. And so when you're looking at the debt ratios, you want to compare, you want to understand the industry, because different industries and different sectors have different standards of debt ratios. If you invest in the banking sector, for instance, then you know that the debt ratios would traditionally be higher than most other companies. And if you invest in another sector, that like the food industry or so, then the debt ratio would be a lot less than the banking industry. And so a good way to actually figuring out the debt ratio is by finding out the amount of leverage that the best company in that sector has, and then you look at the company that you are interested in, and then you find a third company or even a fourth one, just to ensure that there is some sort of average that the companies are within. And so that's the best and the easiest way to actually figuring out how to actually know what the industry standard is and what the industry sector is. And so these are my ways and top ways for actually identifying good companies from the bat. So after you do all of that, now you want to really start comparing. You want to look at the market cap. So if it's a much smaller company that you're interested in, you look at when they had an IPO. So if that IPO was within the past 6 months, the past 12 months, the past 15 months, you want to take that into consideration. You want to also look at what the company has been able to achieve. And the best way to do this is by actually attending the earnings call. And then you have this every single quarter. Yes, they have their earnings call every quarter. So every quarter they have to actually release data and put out what they actually have been doing, what their targets were for the quarter, and did they meet their targets, did they miss their targets, or did they actually beat the expectations of these targets. And so you want to actually plug into the earnings calls, and that's knowing exactly what is happening within the company and what the company is doing. And that would actually make you much better in terms of knowing what the company is doing, what the direction is, and how you go about investing. So are you going to increase the amount of funds you invest in that particular company? Are you going to keep it relatively stable, or are you actually going to decrease the amount of investments? And so these are the questions that you need to be asking and actually have answered at the end of the earnings call. And companies usually have an email address, so if you have additional questions or you're unclear about something, if you don't get to ask a question live, you can email them and write them with the questions, and usually they will get back to you. So now the market cap. Now you want to actually look at the market cap, and my way of approaching the market cap is I find the company with the largest market cap in the sector, and then I find the one with the greatest growth potential. And then what I do is I actually find a percentage of that market cap, and then with that percentage market cap, now I say this company that I want to invest in, if it should get this percentage market capitalization, this percentage of the actual market, then this is how much the share price will be. And so I tend to work it in the reverse order. And then once I actually find the market cap, and that tells me how much of a percentage of the largest it is, then I look at the actual stock price, and then I look and I say, will this company meet this stock price? And if the answer is no, then I know I have to actually find a much smaller market cap. And if the answer is yes, then I continue proceeding, or even I readjust, and I might find a larger percentage of the market cap. And so that will actually give me a much higher stock price. And so these are just some of the tips and tricks that I use when I personally am investing and looking into the companies. And so if your answer is no and you find a smaller market cap and it's still no, then you might want to reconsider the actual company or even the industry over. And so that leads ties perfectly into the next topic, which is you want to understand the industry and know the direction of the industry and the perception of the industry. So if consumers are moving away from this industry, then you don't want to be putting your money in the industry, even if it is doing well at this particular point in time. And the best example of this I will give is look at Apple. So Apple, when they actually came out with the iPhone X's, they actually had used lightning cables. And so with the lightning cables, Apple, no, you actually had to buy a particular charger that was only able to fit iPhones. And years later, the there was a case between Apple and the European Union, and so the European Union told Apple that they either needed to change their cables or they'd be banned from the actual European market, because their saying is that Apple is actually costing persons too much of an unnecessary expense. And so iPhone 15 came out and they actually started using USB-C cables. And so what that is saying is that yes, the lightning cables are still going to be sold, but in the next 10 years, do you think that a lot of persons will still be buying lightning cables? So if you are in that lightning cable business and you see that Apple has changed from the lightning cable to the USB-C, then you know that at least for the next year to 3 years, you still be manufacturing and selling the lightning cables, but as the years go by, you actually will start be producing and manufacturing less and less of the lightning cables, and you start producing more of the USB cables, because as time goes by and as you get further into the future, then you know that the demand for the lightning cables will become less and less, and the demand for the USB type cables will actually grow and increase. And so as the manufacturer, you would start decreasing the amount of lightning cables that you would have been selling over the next 1 to 3 years, and then by the end of the third year, now you know you would still have a few persons that would still have the old models of the iPhone, but and so you just have enough just to service them, but it won't be the main business again. The main business now would be to the USB type cable. And so this is really what I mean when I say understanding the market and knowing the direction that the market is going in. So if you have invested in a particular company or there's a particular company that's doing well, you want to ensure that the next 5 to 10 years, this will still be a pretty dominant and strong industry and sector. You don't want to invest in a company now that's doing really well, and then 5 to 10 years down the line, they're struggling. And this also happened with Blockbuster and Netflix. When Netflix came out, nobody really believed they would have taken over the market. And now with Blockbuster, I think there is only one Blockbuster store in the entire United States, and this was the one of the largest businesses in the 90s and the early 2000s, and Netflix came in the early 2000s and changed the game. So by about mid 2000s, blockbusters started shutting down. So that's really what I mean when I say understand the industry and know the direction and what consumers want and what consumers need. And so that's really all for today's video, guys. Thank you so much for tuning in. If you like this comment, I ask you to give us a thumbs up or a like wherever you consume this material, and feel free to leave any comments down below that you may have, and subscribe or follow the show so that you do not miss out on any new episodes as soon as they are launched. Until next time, take care. Love you guys always. Bye.